Hello traders, Gary Wagner here just after 1 o'clock in Honolulu, 7 o'clock in New York. It is Tuesday, 16th day of June, 2020, and this is the daily report for gold and silver. Although during our technical studies we are going to talk about the fact that gold is still trading in a narrow and defined range, there are factors that could definitely take gold substantially higher. Now, first of all, Chairman Powell did speak to the banking committee and really gave a mixed message, but overall acknowledged that the Fed is probably going to be extremely accommodative and dovish till 2022. We also have the fact that we have a skirmish between China and India on their borders in the Himalayas. And lastly, we absolutely have a second wave or resurgence of the pandemic that was starting to flatten out in terms of the curve as people got back to work and economies get ramped up. Specifically in China, Beijing has got a lot of issues. They have been shutting down certain areas of the city itself. South America is having a tremendously hard time dealing with the virus. And in the United States, we are definitely getting a second wave. These factors collectively, I believe, could be the fundamental news that really incites gold pricing to move much higher. We'll talk about that throughout the rest of the week, but first, to the price board. It is quite obvious that the testimony that Chairman Powell gave today to the Senate Banking Committee was considered extremely dovish and bullish for gold. Nonetheless, gold is still mired within a narrow and defined trading range. It did close up by $7.70. We're looking at August futures at $1734.90, up 0.45%. When we look at spot pricing, it gained about $1.54 and is currently fixed at $1726.10. Platinum gained $17.80, which is a 2% rise, very respectable rise at $839.50. Palladium gained about 0.4% and is currently fixed at $1940.40. Silver also showed a significant gain of about 1.25%, a 22-cent rise at $17.62. And all of the rises were against the grain of a stronger U.S. dollar, up over 0.3% at 96.98. Equity scored some very, very solid gains. A 500-plus move in the Dow, 26,298. And then lastly, the Standard & Poor's gained approximately 2% at 31.24. Let's take a look at our current technical studies. There's no doubt we did have a fractional gain in gold trading in New York today. We've switched over into the Australia morning on Wednesday, and what we are seeing that gold is currently down by about $2.10 at $1734.20. As you can see, I've drawn in a couple of lines, and they're clearly showing a compression of range. At the same time, what we must acknowledge is first, we in essence have a flat bottom or a series of lows that came in that were absolutely support levels, and they come in roughly at 1665. That is the 23.6% retracement. However, at the same time, when we look at recent activity over the last, let's say, 10 trading days, we can see that we have a clearly defined series of higher lows and, to a less extent, a series of lower highs right in here. Nonetheless, in terms of the top, we have key areas that we've not been able to surpass. One comes in roughly at 1775 and then at 1765. That's this one here. Of course, the major one comes in at the record high this year, which is 1788. My sense is, unless we break above or below this sideways channel that has so defined gold prices over the last couple of months, we're still going to sit in a narrow and defined range, which means that we'll look to sell the market at 1765 if we see it hit and then find some sort of resistance. At the same time, we will wait for the range to come down to between 1700 and 1680 before we actually initiate a long position. And that's simply because what we have is a range and not any kind of a breakout in the marketplace itself. And it is for that reason that I am recommending that we maintain a current neutral stance in gold. Traders, I really wanted to take a much longer term view of the market. We've seen this market move up tremendously when we consider that just last year we had gold trading at approximately $1,250, a little bit above that. From that particular point, we saw a pretty large spike. That spike took pricing up to these levels at 1560, and they kind of then came down and leveled off. But then what we saw was absolutely a sideways trading range, a market in consolidation, and that occurred up until the middle or end of December. And then we had this tremendous spike up. This took us to about 1700, but then a tremendous move down. And the move down occurred up until March. This is the beginning of March. It comes in right here. You can see that the market was still moving down. This was the initial gut reaction to the global pandemic. We moved from about $1,467 up to the record high at $1,788. But then look at what we've seen over the last couple of months. Each candlestick represents a full week in trading, and that is absolutely a defined and narrow band or trading range. Now, if what we're looking at is similar to the action that we have seen, is to see a similar reaction, meaning we've had a sideways market here, a sideways market here, and now we're in a sideways market right here. On each prior occasion, it was followed by a large spike to the upside, and then back to a sideways market, spike to the upside. In this case, it did come down, then spike up. But once again, we're in the sideways market. What that tells me is that at the point in which this market breaks out of this range, which is defined by about 1665 to about 1765, about $100 range, we should see this market break and break hard. I still believe to the upside. I believe that if it can challenge 1788 and move higher, it will take out $1,800 without a problem, and maybe even take a stab at the all-time record high. But that's a technical basis. If we see the economy improving greatly, we could see a break to the downside. So it is all contingent on where the U.S. economy goes from here. This has been Gary Wagner, wishing you, as always, good trading. We will talk to you tomorrow for the next daily update and review on Wednesday. Bye-bye.